Hey, good evening, everybody. This is the December webinar of Real Estate Investing Made Simple. I'm your host, Travis Hill, and tonight we have got a special guest that's going to be talking exclusively about the majority of who we are as far as limited partners in syndication. And joining us tonight is Litan Yahav, and a quick bio about Litan is, before my computer freaks out, he's a former officer in the Israeli Navy. Together with his co-founder, successful diamond company called Sagoma, and it was revolutionary because it kind of changed the way diamonds are displayed and really kind of helped the global diamond industry. When that company was exited, they became passive real estate investors with complex and diverse portfolios. And they didn't have any really technological solutions to manage, track, and monitor their wealth in a full range of all their investing LPs in the syndication. So they decided to build a startup, and that startup became Vyzer. And so what he's going to talk to us today is about the role of being a GP and his experience in investing in multiple syndications as an LP. So Litan, the floor is yours. Thank you for joining us this evening.
Yeah, guys, you guys are awesome. Thanks for having me on. I don't know if my internet is off or not, because let me know, like raise a hand if it breaks up, because I did see some like bumping in the connection there. I am on the other side of the world. I'm in Israel at the moment, so bear with me. So I thought what I talk about is sort of give some background about me. I had this presentation I prepared. I'll walk through it. Questions, like stop me. Any things you guys think I should sort of emphasize or focus on, like feel free. All right. Can you guys see the full screen here?
Yep.
Awesome. All right. So I'm going to give what I thought about talking about are two aspects that I'm really passionate about. One of them is sort of keeping passive real estate investing passive. And the second thing is sort of how me and my co-founder look at vetting real estate sponsors, operators, and the whole mix of that. Because that's basically what we've been doing for the past 7 years. So those are the main subjects. I'm gonna start sort of like just giving a background about me and the investing stuff, and then dive into why I chose to invest passively and how I personally vet GPs. And like I said, feel free to stop me, guys, as we move forward, all right? Ashley, my internet okay? Or am I breaking up? All right, cool.
Looks good.
So just a little background. So I'm 40 years old, married, I have 3 kids. I was born in the States. And when I was 9 years old, we moved to Israel, and I've been here ever since, back and forth a lot. And in Israel, military service is mandatory for 3 years, both for men and women. And I was in for 6 years in the Navy as a naval officer, and served there for 6 years. After that, went to school, studied law and business here in Israel, and met my current co-founder back then as well, which industry. And basically what we did is we created these images through a machine. We basically developed like a microwave machine that you put a diamond in, and it photographs it from like hundreds of different angles and creates this like really high resolution image that you guys can see here. And it helps sort of diamond dealers and retailers sort of get a sense to what they're going to buy. And this went well. We educated the whole diamond industry around the world. This was back in 2012. We sold this company in 2015 to an online e-commerce platform called jamesallen.com, which then we scaled this even more to sort of be the standard for diamond imagery around the world. Almost every diamond today goes through our machines. And in 2018, me and Tomer, my co-founder, back then as well, and currently as well, we decided to move on. And so that was sort of the backstory of that. What happened at that point was that we received a chunk of money. It wasn't tens of millions of dollars in this exit, but it was enough for us to take a minute, sort of travel a bit with our families and decide what we want to do next. And during that period, sort of, we obviously we were approached by a bunch of wealth managers and private banks to sort of, why don't we give them our money for them to manage it for us? And we decided, I mean, we can do this. We're smart enough. We can do this on our own. And the cool thing in Israel is that every second person here invests in real estate abroad. So here in Israel, every sort of the equivalent of the 401k here is mandatory. So everyone who has a W-2 income by definition has a retirement account, and any excess cash they have, they tend to look for alternative ways to invest it. And like everyone, real estate is like this sexy asset class, and everyone wants access to it. And so many people here have been building GPs, syndications to invest in the US and in Europe. And a lot of everyone knows a guy. And so everyone has a friend who also invests with them. And so we just talk with friends and friends of friends and just started to invest with these operators. We didn't know the naming yet, right? But the first point of that was that we sort of, and I'll dive into this, but our first two deals were actor real estate. So we bought 2 single family homes in Ohio. It was supposed to be full turnkey, and it ended up being a nightmare. And at the same time of doing that, we also put money into a few syndications as an LP. And just the single family homes were a total shit show, and it was so much work. And then we decided, and at the same time, it doesn't even generate the returns. We were unlucky. It was a lot of work. Why don't we just push everything into syndication? And it's for us, that was like, why doesn't everyone do this? And that opened our mind sort of like to this passive approach to real estate investing.
Litan, why do you think that when you said that everyone there's got a 401k and then everybody invests abroad, is that a society, like where does the Israeli people kind of like, clearly that is not normal here in America. So what are you guys doing different over there?
No, I mean, well, first of all, the fact that everyone here feels like their retirement is like we're set. Like we don't have to worry about the retirement because we have like the employer match and your contributions as well is mandatory. You don't have a choice and the employer doesn't have a choice. So everything is you're saving. You have savings, for example. And so when you want to look for that, that's one. Two, I think there's a risk-taking mentality here. You see that because we have this huge startup scene in the military, and like everything is like all around that. So that also, so you see like people making a ton of money in real estate abroad. So like, I want to do that as well. And then everyone sees these like quick wins and stuff like that. There's a lot of, obviously when there's so many people doing it, some are going to be amazing and some are going to be bad. Some are going to be scammers. And so it's still hard to find good people. But anyway, I think that's what makes it different. So yeah.
Very cool.
So, I mean, basically start to invest it. And then after investing it, we like I said, we stopped actively investing in like single families and
oh shoot.
And these are good problems to have, but it became a headache. Like I'd get emails from an operator, from a GP. And I'll dive into what that, I mean, you guys know this a lot better than I do, but I'll dive in a second what that means, like the GPLP, like what these syndications even mean. But sort of I get emails every quarter from these GPs. And I mean, I'm embarrassed to say I didn't even remember like how much I invested, when I invested, what is this distribution, what I expected, are we on? And even if I did remember, like 2 weeks later, I'd get money in my bank account and I wouldn't even know how to identify it. And again, good problems to have, but still like we had this headache and problems managing. And sort of that's sort of what led us to sort of build Vyzer, which is we built this for ourselves to make sure that our investments stay passive, because I want to make sure that everything is in one place. Everything is automatically tracked, projected in one place. Like if I had a family office, this is what I'd want. But I don't want to pay. I want to pay tens or hundreds of thousands of dollars a year. I want a platform that does it for me automated, mainly computer, like AI or computer based. And so that's what we built for us. And then a bunch of friends wanted it as well. And that's when we decided to build Vyzer and offer it to more people like us. So that's the backstory of that. All right. I think that there's a question in the chat, but for some reason I can't open it on full screen here.
No worries. If anybody question, that was just Ashton saying it for people to drop them in there. If there's any questions in there, I'll just kind of either interrupt you politely the best I can, or just let you know if there's a question. So you still have free reign.
All right, cool. So all right. So like I said, my objective is sort of to keep real estate investing as passive as possible while generating the best returns. And this is really important because the passiveness there's always a trade-off here, right? Because the more passive you are, many times the lower the returns will get. And I'll dive into that in a second, but I think it's really important to sort of understand that when you invest in general in real estate, specifically in real estate, but also investing generally speaking as well. So what I want is less of this and a lot more of this, like traveling with my and just like having that passive income. And what we sort of identify is we need to balance. We need a balance between the passiveness of investing, which means basically, all right, how passive or active are we in sourcing deals, financing those deals, closing deals, operating, exiting. I think the more obviously the more you have to deal with each of these line items, the more active it is, and the less you deal with it, the more passive it is, right? But on the flip side of that, there are the financial benefits as well. There's always the risk return, liquidity, and taxes. And there's probably a bunch of other in each category. But the idea for us is sort of to balance these two aspects when we think about passive investing. And like in the example of the single family homes, like that was a ton of like sourcing and it was mainly operating it and exiting. It was just like it was a headache for us. But the potential risk of the return of those risks was high, although we were unlucky and it was low, not liquid, and taxes were, I guess, indifferent at that point. It was a good loss, at least for an active loss. So just some examples, all right? So I chose sort of to put on this spectrum 3 different types of subclasses within real estate, right? People that go and flip homes. There are people that invest as like I do as a syndicate, as an LP in a syndication. And then there are people that go and buy REITs, like tradable REITs in the stock market. And there's a bunch of things in between and different asset classes, but I'm trying to simplify it. And even adding to the simplification, like to this passiveness and 3 levels of the financial benefits. Low, medium, and high.
Those for those listening, an REIT or a REIT is a real estate investment trust, or like basically a traded entity, just like a typical stock.
Right. And just like another note on that. So when you think about what these REITs do, is these are companies that go and buy properties, or single properties or multiple properties, and then they'll go and they'll list these properties on the stock exchange as a REIT. These are traded REITs. There are also like endless types of REITs, but like that's the general aspect of it. And then the thing is, when you buy a REIT, it's like buying a stock. And so REIT stock many times does not reflect the underlying asset. So you can buy because people want to buy it more or less than you do, not necessarily resulting in the price of or reflecting the price of the underlying asset, the property. Make sense? All right. Also,
it does.
All right. So let's dive into sort of the way I sort of look at this. So if I'm a flipper, my passiveness is very of 1 to 3. It's very low on passiveness, but risk return, like the risk is high, but the return is also potentially high if I go and I flip homes. Now, if I'm I'm an LP in a syndication, I don't think it's 100% zero, like 100% passive, because you do have to go find an operator, and then that operator will send you deal flow, and you have to analyze the deal flow and understand if you want to invest or not. But the risk return is also the risk is a little lower than flipping, and the return is also a little lower than flipping. And then if I go to the third, like to to the extreme other side, which is a REIT trader, the passive that's there, you can buy a REIT with a click of a button in Robinhood or whatever, right? Because it's stock. But the risk return is relatively low compared to the two alternatives. And now there are edge cases to anything here, right? And anyone can argue otherwise, but sort of this is, if I'm simplifying it completely, this is how I lay it out. And I'm really curious though, like for you guys at Valkere, like do you guys see this sort of similarly? Do you guys have a different approach to this?
Yeah, definitely. And I think the more you get familiar with who you're working with, who you're investing in, it probably makes it even more passive. But yeah, absolutely. I agree with you 100%.
Yeah, I agree. I think once you find, and we'll get into that also at the end, but like once you find like an operator that you trust, then the passiveness really becomes very high on the syndication level. So yeah, I mean, I've invested, me and my co-founder invested, I think, with 10 different GPs over the years. There are some that we stopped investing with, and there are others that we doubled down on with the next deals when they came out, because we didn't have to check anything, right? Just, all right, we got an email saying, hey, there's a new deal. If it matches our strategy in terms of like risk return, then we're in. If it doesn't, we're not. But we don't need to vet the operator again, right? So
yeah, that makes sense.
All right, so that's the whole first aspect of sort of the passiveness, or the first sort of part of what I wanted to talk about in terms of like passive versus active. I think I went through that really fast, but we'll dive into if there are any questions at the end. The second aspect is sort of the vetting of operators, general partners, and syndicators or whatever. And this is really important, because what matters here, and I can't emphasize, and sort of that's the biggest hurdle you can think of when you invest when you invest in syndications. It's just because there's so many. I think in the US there are like 50,000 GPs for real estate, which is an insane number of alternatives that you can invest with, right? And so that's the biggest hurdle. And I'll dive into like where I see it. So you need to know the people you're investing with. And I think that's so much more important than vetting the deal. The vetting the deal is totally secondary to investing, who you're investing with. And I've spoken with people that are looking to invest in syndications, and they're like going over the numbers of the spreadsheet they receive, and looking at like comparing rents in the area that they're thinking of investing in. I'm saying, all right, that doesn't, all right, fine, whatever, but talk to me about the person you're investing with. Like, and there are questions that I like to always ask, that I've learned to ask over the years, that help me decide whether to invest with someone or not, right? And so we go like above and beyond just to do that first aspect of find who we invest with. And it could be
Ashton asked, what you mentioned that a little bit. Can you dive more into that criteria, right? When it's obviously easy to, once you get the trust established, right? But what was the criteria that said, we're not going to work with you anymore?
Yeah, so I'll get into that in a second. I have that. So that's exactly it. All right. So I have 5 points that sort of I ask myself before I invest. So my first and foremost is like, all right, do I have a personal connection with this person, with the owners, whatever? For example, like at the beginning when we started to invest, like I said, it was only with friends of ours, good friends of ours from Israel that we knew. And the reason it was important for us is to make sure that these people, or the chance of these people screwing us over, is very, very low to non-existent. Because there's so many stories of scammers, of people that like will convince you to do one thing and will steal your money, or so many cases of fraud. And you just want to get that off the table, the way I see it. And I mean, this is 1 point out of 5, but I've spent the most time on this. So I know Ashton, right, from GoBundance, which is this mastermind group we're both part of. And I joined GoBundance 2-something years ago just for that purpose, to find people I can trust, because this is like very high quality people. There's a high barrier to enter, and it's like I want to create these personal connections with people that I can trust to invest with. And there are many other ways to do that. You have to join mastermind groups, right? You can speak with the people you're investing with, find mutual connections with them, and get to know them on a personal level, and just like that for me is the vetting process, the first part of it. The second part is understanding the role of that person you're investing with. So this, again, at the beginning, we had no clue what we were doing, because you meet someone, they send you and what the whole composition of the syndication was. And I want to give a few words about just what a syndication is. There can be a syndication of angel investors that invest together into a startup. You guys hear me all right? Because I just got unstable. All right.
Yeah, it cuts out every now and then, but for the most part, we were getting it. Yeah.
Yep.
Shit. All right. So, well, I hope it's good enough for you guys to understand. I even went on. I connected a cable, like I have an Ethernet cable connect just to make sure I have the highest quality. I have like 250 Mbps here. It's really weird that it's disconnecting now, but it is what it is.
Yeah.
Anyway, so a syndication essentially is just a group of people that invest together in something. It can be a startup, it can be a real estate deal, whatever. But in that syndication, there's going to be someone who's arranging the syndication, finding the deal, vetting the deal, and then there's the people that invest the money, which is the LPs, right? That's sort of super simplifying it. But within a syndication, there are different types of people, because close them, finance them, raise the money and all that. And then there are other people that might not be involved with the day-to-day operations of the deals, like talking with the property management firm, vetting the property, going to the banks. These are other people that what they do, they just help with capital raising, and which is fine and important. And they help other people who don't have connections to the main operator. But it's important to know that they're not the operator, right? When you're vetting a syndication or the person you're investing with, you need to know, all right, are these the people that are actually going to get the job done on the ground? Or are these the people that are just helping the people doing that raise money, or other stuff, or get financing from the bank? And I'm not saying it's bad or it's good or bad. I'm just saying it's important to understand the position of the person you're investing with, what their job is in the syndication, because not everyone is like super transparent about that at the beginning. So know the role. And I think overall, I'd say there are three main terminologies for these roles. There's the operator, a sponsor, and a syndicator. And there's so much overlapping about those three words, right? Each can mean a lot of different things. For me, it's always important for me to know, all right, who's the operator? Who's the person? Who's the person or company getting the job done? And so that's the role within the syndication, understanding their role. Did most of that get through?
Yeah, we got that. Perfect.
Yep.
Right.
You're 100%.
All right, cool. Now, the third aspect for me, and there's a lot of controversy about that, and this is just the way we look at it. And I'm not sure that everyone will look at it the same way, but it's sort of, how big are they? Are they like this massive general partner that has 1,000 limited partners and does deals every other week and has been doing this for 25 years? Or is this a small operator that does one deal a year, has a handful of investors, 10, 20, 50 investors? And so for us, it really matters to understand how big this organization, this syndicator, this operator is. And the way we see it is we always prefer to invest with the smaller guys, the people that have a smaller operation, who do 1 or 2 deals a year, 3 deals a year, that really go all in on finding those deals and are really hungry to deliver and will never disappoint the LPs, and don't have like this enormous overhead of these, like for us, like these beautiful offices and a huge team of like 50 people. And because it's just so much to operate, and then things. When you do so much deal flow, like every other week, you send a deal to investors, and you have 1,000 investors. Some of those deals fall through. It's just a numbers game. And it's okay. I'm not saying it's good or bad. I'm just saying the trade-off, obviously, is they do so many deals. It means they have a lot of experience. So good. But for me, I want to be shoulder to shoulder with this person. I want them to sort of look me in the eye and know, all right, I'm your investor. You're the operator. You're going to do everything you can to make sure that this works. And it's okay if it doesn't, because it may, sometimes it won't. But like, I just feel that personal connection is a lot easier and with the smaller operators, and they're a lot more hungry to deliver. That's sort of just understanding how big this operator is.
Is that a number of assets under management, or a number of doors, or a combination?
I don't really care how many doors they manage. What I care is like, for me, again, and this is only I'm emphasizing, this is my personal approach and my co-founder's personal approach. Like, if they send me a deal every month, a new deal every month, that means they're too big for me. I don't want to have a deal every month. That means that's just too much. I don't need them to have these beautiful offices that with a team that there's one person who talks to me ongoing, and there's another person who does the paperwork, and there's a different person who works for them who sends me gifts. I don't need that. I want, like, do what matters for me, and that's make my money grow and don't lose it. That's all I care about.
Yeah. So
that's what I look at. I don't care how many doors they have. Again, it all goes back to have a personal connection. I trust that these people tell me the truth, and they have experience. They're not like this. I have invested with one operator who did like in their first deal, and we were really lucky. It's a higher risk for sure. And also we'll get into this. So it's also like the waterfall structure. Right? This is also relevant many times to how big they are, right? Because if they're really big, the waterfall tends to be more GP friendly as opposed to LP friendly. If they're small, they're sort of hitting it out, they're going to be more friendly towards the LPs. And what that means, and I have an example of a deal in the next slide, something down the road, but sort of so you split the profits, the GP and the LP split the profits, right? And when you split the profits, there's going to be this like minimum threshold, most of the time, this preferred return that the investors get. And then everything above that, there's usually a split between the GP, the general partner, and the limited partner. And when you see these big guys, usually it could go up to 50-50 split above the preference, just because these guys have so much experience, they're so big. And they say the waterfall is such that when you get above the preferred return, they're going to get 50% of the profits. As opposed to like really, really tiny operators, like the first time going through that, sometimes they'll go down to 90-10. So they'll only take 10%, and you'll get 9. Fair, and we'll dive into that, I think, in a second. So that's the waterfall, and also the correlation with the size of the company usually.
Can you kind of talk about what a waterfall is and how that works? Because I know that, and I think it's easy to kind of get into hurdles and and just kind of like, because I know that waterfall is not applicable to just syndications, and waterfall is kind of like the visual display of the breakdown of information.
Yeah, there's so many terminologies also for this distribution of profits. The waterfall basically dictates how the profit is split. I mean, overall, like what you're like, and the reason it's a waterfall because every threshold, like many times they'll put hurdles or threshold, which means when you cross this threshold, there's this split and another threshold. The structure itself of the waterfall is what I mentioned before. So they're sort of, if they define that up to 8% of profits, everything there's a split, let's just say 70-30. And then if it reaches 15% annualized return, anything above that, there's a 60-40 split. That whole thing together is considered the waterfall of the deal. But I mean, you guys correct me if I'm wrong. I'm just saying this from my experience as an LP, like you guys as the GP. Is that correct? Is that an accurate assumption of what the waterfall structure is?
Yeah,
Yes.
yeah, that is. And some are real simple and then some are real complex, like what you said, where there's multiple thresholds to hit and then multiple split structures after each threshold. You know, everybody's always trying to make it more beneficial to themselves, I think, obviously. I mean, that's the nature of the business, I suppose. But yeah, I think you're right. Some of these are real simple, but some can be really complex. But it's important for you to understand before you invest, obviously.
Yeah, if I think, in my personal opinion, if you need a flow chart to figure out how you're going to get paid, you probably want to be wary of that.
Exactly.
Right? Like it shouldn't be like arrows and circles and squares moving off into, did it do this? Yes, no, and then it dives into some forked thing. Like, you know, and I'll just do a personal shout out, you know, as being an LP with Valkere, like the two opportunities I've had to invest with Valkere as an LP, like it's super straightforward, right? That was just like, this is your pref, this is what's going to be. There you go. And I think
that's because we're bad at math.
Well, that's fine. I mean,
I'm just kidding.
You can be bad at math as long as returns are there. You can be as bad as you want. I don't really care. But and they've been great. So your math has worked out. But it makes, for me, being a W-2 earner, it makes that passivity easier to digest, and then also gives me more security. That is the simplicity of it, is the security piece, is what I'm trying to say.
Yeah. And that segues into the refinance event. And this is sort of one of those things that we didn't even ask at the beginning, because many people don't think about it. And I'm not saying it's really important to think about it. I'm just saying it helps. I found this is sort of that, it helps identify if the person, the GP you're talking with, knows their shit. Because I've spoken with GPs around this after I learned to ask it. And you see the responses many times are like, wait, you know, they'll give me an answer and I'll say, are you sure? Because it doesn't make any sense. And they'll go check and they'll come back to me and say, you were right, I was wrong. It really works differently. And so it helps sort of identify a lot of aspects of it. And I'm not saying there's a good or bad answer. I'm not saying there's a right or wrong way to do this refinance. And I'll explain what I mean in a second. Even if the person you're asking will go and say an apology and say, you know what, I'm sorry, like we've never been asked this before. Bullshit me, right? They'll just tell me the honest truth. So owning their mistakes, which is also important. So what this means is, like, when you invest into these syndications, let's say you invest $100,000 into a deal as a limited partner, and you're supposed to get 8% cash on cash return every year, which basically means if you put 100,000 in, you're supposed to get $8,000 every year. Doesn't matter, distributed monthly or quarterly, doesn't matter. Annualized cash on cash is 8%. And then after 2 years, there's a refinance event and you get $70,000 back, which is great because the deal isn't over. You still have equity in the deal, but you got a large chunk of your capital out, which is great. What that means from the general partner side is they went and they received another loan, which enabled them to pay out the limited partners. Now, this is where it gets tricky, right? Because what happens now with regards to that 8%? Is it 8% on the remaining 30? Is it 8% on the 30 and then everything above? Now you already reached the waterfall, right? Because now you're getting your preferred return essentially. Now there should be a profit split or something. And again, each deal has a different type of structure I've seen. Each operator has a different approach to this, and that's fine. But knowing what the structure is and how it works will help you not get surprised, and it'll also help understand how the GP sees this partnership. So for example, like I've had deals, and also I've had a good problem to have, but I've had a deal suddenly go through refi, distribute money to my bank account without even telling me. And I'll suddenly have cash in my account and I didn't even know about it. And then I'll ask him, hey, what's this distribution? Like, where's this from? Oh, right, there was a refinance event and we distributed cash. I'm like, okay, what happens now? And then, all right, from now on, our distributions are based on your remaining capital. That's all. There's no split above that. There's no profit distribution, nothing, just that. Now, I have not invested with this company again since then, but I'm still in that deal. This was like 7 years, like this is my first or second deal in a syndication. And after 2 years, I put 100,000 in. After 2 years, I got 70,000 back, or 66,000 or whatever. And instead of getting $8,000 every year, now I'm getting like, I don't know, less, a lot, like 70% less, for 5 years already. And like, and they haven't sold the property. There hasn't been a refund. They haven't, like, and it sucks. Like, if I would have known ahead of time that was a situation, I would have maybe thought twice, or I would have done the same thing, but I would have been aware of it.
Yeah.
So I've been asking that question every time I invest with the GP since.
And that brings a really good point, right? Because you've got to be able to have the transparency as the GPs to be able to have those questions, to answer those questions from the LPs. And, you know, going back to what Valkere does so well is that other members of the GP, like, they provide the Flight of the Valkere, the monthly newsletter, right? And you're getting the good, bad, and the ugly to the LPs of like, hey, this is a great things that happened. We're at 98, 99% rent. Oh, we had a busted water line, so we had to pay for that. But you still were able to meet the distributions to the LPs. And then, hey, we're going to be working on dropping a new playground, and we're getting quotes for that. So we're excited to have that come happen. You know, so it's that transparency is what reinforces that trust, because I don't think anybody wants to have a large chunk of their money just deposited in their account and then have their interest rate adjusted, their annual return adjusted, just because somebody got a wild hair. They just thought they were going to do it.
Yeah. And I mean, I think refinances overall in the near future won't happen as much anyway. So it doesn't matter that much because of the rates, but it still is a question that I still would ask any deal I go into. All right, so here's sort of that example, like what a typical deal to look at what happened before over the past few years will be different, but this is the way I look at it, right? So and you guys tell me if I'm off or on, like, because you guys are more in the weeds on this. So the way what I've seen as a typical multifamily value add type deal, which means basically the partnership goes and buys a complex that has value add to it, meaning it requires some sort of renovation to the common spaces, to the apartments themselves or the units. And so essentially when you go and you buy this type of property, you go in, over the process of holding it, you renovate those common spaces, you renovate the apartments themselves or the units themselves, you increase rents, and then after a few years, you've added more value and you can then sell it for a higher price. And that's sort of good for everyone. So that's sort of, I totally simplified it, right? But that's sort of the way I see it as an LP. Now, what I've seen is that these deals usually, I mean, I've seen minimums of like 25,000 and minimums of 250,000, but let's just say $50,000 minimum investment. Just put at 8%, which means that this does not mean necessarily that the cash on cash return every year will be 8%. That I broke up there, right?
Yeah. Yeah.
So I've seen, so the 8% was sort of not the cash on cash return is what I want to say, right? And so many times been not misleaded, but I didn't understand it that way. Because I get first year would be 5% cash on cash, but that made sense, and that was the plan because overall at the end it would sum up to 8% preferred return annualized. The distributions are usually every quarter, and then after 5 to 7 years there's this exit, and then there's an upside, which usually results in this IRR, which is the internal rate of return of this deal, being 15 to 17% to the LP, which for me is pretty amazing to not do anything and get 15% annualized IRR on my money. And if there's a refi or there's not a refi, there's a refinance, which is that split. So the hurdle will be in the waterfall. The hurdle will be 8% preferred. Then anything above that, the most common thing I've seen is 70-30 split. Again, like I said, I've seen more than that and less. But that's sort of the overall, really general layout of how this deal looks. What do you guys think? Like, is this like
yeah,
point?
that's pretty. Yep, that's.
Yep.
I mean, that's pretty much what the coaches are teaching, and that's how most starters like start at, really. Unless they need to bring the IRR up, yeah, they'll do like a higher split, like higher equity split to the LPs to get the IRR up to them. But yeah, that's generally what you're seeing.
Are you guys seeing the same types of numbers moving forward?
Yes, but to do that, you have to find better deals, right? Better mortgage rates. You have to find, I mean, you have to get creative with like the deal we're doing right now. We're assuming a HUD loan, an existing loan at a 2.5% interest rate for a 28 years amortization. So because of that, we're able to keep these really good returns. But I think there's going to be a lot of compressed, there's going to be compression in the market and less returns on some of these deals. And people are already prepping their investors talking about that because of it. Yeah, because the mortgage rates are going up because, less people are selling or less people are buying, whatever. So depending on what market you're in.
And you look at, cap rates is kind of what GPs look at, and the cap rate has to do with income and value of purchase price and that relationship, right? And they're getting compressed, meaning that a bigger cap rate, a higher percentage means that it's good to buy. A smaller percentage means it's tougher to buy because the numbers are the margins are thinner. And so you hear that term meat on the bone. And like a lot of them are just with adding the current rate with the amount of reserves and the cap rate being so much more compressed, smaller percentage, it's harder to create the margins. I've seen a lot of returns be in the 6%, right? Mm-hmm. And I'm sure in the next year, they may even get down to 5% something. And so a lot of people that I speak to, they're like, oh, that doesn't even beat inflation. I'm like, true. If you got $100,000 and it's just sitting there, would you like to lose 8.5% or 7.1%, as we just kind of realized the other day before the Fed hikes it up again? Or would you like to get a 5% return and just kind of lose 2.1% of that money to inflation? So you just kind of have, it's that education and just helping them kind of realize from those potential LPs that their money can be used more efficiently.
Right. So that's sort of like an overview of a typical deal, I guess. And moving forward, like you guys mentioned, that's interesting the way you guys look at it, and I think it makes sense as well. So sort of summing it up for me, the bottom line of this is sort of the passive strategy needs to match the goals. So for me, my goals are not to be involved, to find people I can trust and generate those types of returns. Obviously, if your goals are to generate substantially higher returns, you need to be more active. And if you don't really care about the returns or that much, you can even be more passive than me and do REITs. But that's the way I see the passive versus the goals you're looking at. And I think obviously number two, and I've emphasized this a lot through the whole. And so, you get me?
Yep, there you are. Yeah.
Yeah, so I mean, It's what I thought to sort of would be interesting to talk about, sort of like real estate investing made simple. Like, what do you guys, like, anything specific you guys think we should double?
Yeah, I think some of you were talking about you've been invested with, I don't know, something like 10 other GPs at this point, and a couple of them you have not reinvested with. I was wondering what was the big, reason for not reinvesting with them? Was it like the communication? Were they not communicating? Were they not clear and open with what they were doing with your money? Was the performance? Was it something else entirely that, I don't know. Why didn't you reinvest with those people?
So one was because of the communication. So like that deal with the refinance event, that was literally like wholly not communicated. It didn't make any sense to us. We just haven't invested with them again because of that. Sort of felt communication and transparency a little.
Yeah.
There was another one sort of that we didn't invest again with because it was just one man show, and we were just like, I think 10 or 15 LPs. It was a ground up development type deal, and he was just really, really scrappy. He wasn't sort of lying to us or screwing us over. He was just like, everything was a mess. Like, his spreadsheets were crazy, and he didn't, and the reports were like throughout the deal, and was like, and this wasn't the first deal we did with him. Like, not as scrappy as the first deal as well, but the returns were like amazing. Like, we did, I think 30 or 35% IRR, which was great. And like, but we didn't. Once that happened, and the mess created situation where the returns were low. We didn't lose money, but was really low.
Yeah,
and that's okay if everything is sort of going, if it's organized and everything else works. It's okay if the returns are low. I'll still invest with someone again, even if the returns don't match the expectations. But if you see they operate in an unorganized way, or unprofessional, I'd say, then that's also one reason we stopped investing with someone. And what else? Sort of, I mean, I'll give you an example to the extent where we trust people and want to be passive. So we invested in this deal in Brooklyn a few years ago. We bought this like 3-story building. Just like me, and we were like 4 investors, and this guy, the GP, for example, it wasn't like a proper syndication, like in a sense like that, but so I mean, he went and he bought a property, and the idea was within a year and do 30% to us. And after he bought the building, like a month later, he gets an offer to sell it for 10% profit. And we told him, listen, we don't care. It's your call. Like, we can't make that type of decision. It's your call. Like, if it makes sense or it doesn't make sense. We trust you. And he decided to sell it. And I can't complain making 10% profit within a month, right? Obviously, the downside is now you have to deploy it. Right. And so it doesn't necessarily mean it's a better deal than 30% IRR. Because then you have
that's so 2020. Gosh.
that was like in 2017. I think. 2021 we had an exit. This was the best syndication deal we did. Was like 33% IRR on a multifamily value add deal.
Yeah.
That's like, for us, that was like mind blowing. But
it was
yeah,
a good year.
It was. And now I just spoke with another operator that we're invested with in Albuquerque, New Mexico. That was supposed, like, in a year from now, we're supposed to reach that sort of 5-year mark. Mm-hmm. And so remember, like, we've built Vyzer to make sure that we track everything and we can project stuff and know, when am I supposed to get cash flow? And so next year, I'm supposed to get cash flow from all these other assets that are supposed to, like, reach that exit point. Yeah. I want to make sure, because if it doesn't happen, I need to prepare for that, because that means there's cash that's supposed to come in, but it's not going to come in. So I have to find an alternative, right? And so I asked him, you know, don't count on it. We're probably not going to sell that next year, only probably the year after. Just, I mean, we might, but don't plan on it because the market, like, we're still performing, distributions are as planned, like everything's okay, but don't plan on that sale.
Yeah.
And that's fine. I mean, as long as, again, there's transparency and communication. Yeah. So that's on that point, I guess.
Yeah.
I mean, I go ahead, Ashton.
I was going to say, I mean, it's a great investment strategy, and this is why I like it, is because, yeah, if the market is not performing to what you need it to get the returns that you want, you can hold longer, so long as it's cash flowing, right? And you're not underwater. And that's the whole point. And that's why we do value add. And I feel like that's probably the same reason you invest in value add, is because value add typically is cash flowing from day one. Like, there's already tenants in the property. I've never done a ground up development deal, but the reason I've stayed away from those is a little higher risk, right? Because if you're building it and then all of a sudden the market tanks, there's no cash flow whatsoever, and you're sitting there holding the bag. So, and then again, like, if you have a property that is cash flowing throughout the whole thing, and like we're in a market we're in right now, you can hold it for longer and continue to get those returns. Sure, it's not the exit price that you wanted at that time, but you do have that opportunity to hold. I think it's interesting that I see it from both sides, like, because we exited a couple deals in 2020 and 2021 because the market was so good. And a lot of our investors were like, well, why'd you sell early? I was expecting, a 5-year hold, even though they got like a 30 to 50% return over 2 years, but they weren't ready for that capital gains, right? At that time, they weren't prepared for it. So it is an interesting, good problem to have, obviously, but it's, I guess, I don't know, I guess the tax laws are going to be different for you. You live outside the country. I'm not sure.
Yeah, but I have dual citizenship, right? So I pay taxes in the US and in Israel, unfortunately. And my active income is in Israel. So I can't I don't have any active expenses, but I don't have any passive expenses that I can write off to the passive income.
Okay.
But it doesn't matter. I mean, I still do take advantage of the taxes. Mm-hmm. I want to add one more thing, I think, on the point that we just spoke about, because speaking with that operator that I just mentioned, he told me something that I wasn't aware of, that I didn't think about. And he's like, I mean, what's important is that we still are profitable and we still are distributing money ongoing. And I'm like, yeah, but honestly, everyone I'm invested with is distributing now. I mean, no one has stopped distributing that I'm invested with. And then he mentioned something that sort of got me thinking that I need to check from now on in that 5 list, is sort of when to continue distributions, even if it's not profitable, because you can just pay it out from the cash. It's dangerous to do. Do you know what I mean?
Sorry, Litan, can you say that one more time? You cut out. I feel like it was a great cliffhanger. You cut out right at the good stuff.
So when I get a distribution, like when you guys distribute cash, it's supposed to be from the profits of the property, right?
Yes.
And I didn't know that there's a way to manipulate that and distribute cash from the cash reserves. Mm-hmm. And that's really dangerous, because I prefer not to get a distribution and for the operator to sit on enough cash for maintenance, for worst case scenarios, right?
Yep.
As opposed to just being a happy investor and getting cash without thinking about it. And so that's something that we're going to start looking at as well from now on, which we haven't looked at.
Yeah, I've got a couple people in my mastermind, and my friend Adam, he doesn't even know. Like, they haven't reached out. It was a mobile home park that he invested in Colorado, and they haven't said what they're doing. They just, like, no plan moving forward. They think they're going to do something, and I'm sure that would drive you up a wall from what you shared tonight. And then I've got some other people that are like, yeah, we get our newsletters, they're totally updating us. It's freaking awesome. We love it. And so just to hear the different aspects of those, the reaction. Fortunately, Adam's like, I don't really care. Like, I don't need the money or anything. But I'm like, well, yeah, but you still have that fiduciary responsibility to like adhere to something that is making somebody know that you're at least like showing up to the property and somebody's actually doing something.
Yeah, we're actually thinking of adding a feature to Vyzer that you'll be able to throw in. Did I'm making up again, I guess. But when you can throw in your like the P&L from the operator, and it will tell you if the distribution is coming from the profits or coming from the reserves, right? Because it all appears in the P&L, right? Like, and you should get a P&L from the operator every year at least. And so, like, usually when I get a P&L, I don't even look at it. I'll just archive the email, like, or I'll forward it to Vyzer now, and Vyzer will sort of tell me what the situation is. But yeah, so.
Well, Litan, while we're talking about this, like, this is one of those things that, we're really open about what we do in our company. So I'm fine saying this, and we stick to what we say we're going to do. So I'm fine saying this, but it is scary when you learn how to read a P&L, you can see how. So there's a couple ways general partners can move money around. So like they say, oh, I'm investing $500,000 into this deal and I have skin in the game, but then they take a acquisition fee for $500,000 when it closes. So they actually didn't invest anything, right? And that's one of those scary parts where you see guys that just do deals just to take an acquisition fee. So kind of to your point previously, although you were actually using it to stress something else, when people are just doing deals back to back to back, that usually is a red flag to me, because I feel like they're doing it just for the acquisition fee and they don't care about the returns from the time they close to the time they sell. They only care at the time they sell, right? And they close. And so kind of like what you're saying, Travis, is like people get a bunch of investors, LPs, they buy a mobile home park and don't tell anybody what's going on, because quite frankly, they're working on other deals and they already made their acquisition fee, and all they care about is holding for a few years until they sell. And so, yeah, there's a lot of ways that people shuffle to make these deals lucrative. Obviously, using the IRR, because the IRR is highly manipulative too. Using cash reserves to move stuff around, and that's how people get in trouble. That's how that, and there's a couple people going through it right now. We see people getting indicted for this kind of stuff, but it helps if you can learn how to read a P&L for sure.
Isn't it the acquisition fee also called an assignment fee?
I've never heard it called that, but I could, I don't know, could. You could call it, when you build out your spreadsheet on your analysis to analyze these properties, like you can put whatever you want in there, honestly.
Yeah. It's basically, it's basically like refundable EMD.
Yeah.
Like you put it forward, like, yeah, we're going to secure this. Like, okay, cool. You get it back. And then I think there's actually people, correct me if I'm wrong, actually, but there's actually people that will go and fund just the acquisition fee and with percentage on it. And then when it closes, they get their principal plus the interest back, and they just turn that acquisition fee over and over and over again.
Yeah.
Again, when you invest with people you trust, they won't do that to you, right? That's sort of like number one. So yeah, I don't want to have to dive into the P&L to see if they're doing that or not, because that means that rule number one didn't work.
Yeah.
True.
Yeah,
very true. Well, Litan, I put your contact information in the chat for those who want to reach out. Do you want to do a shameless plug for Vyzer?
I think you should. I think it's
should too.
I think it's a really cool app, and I think you can add a lot of value to other passive investors like yourself that do this, for a living or whatever. But I think it's a great way to track what you're doing.
Yeah, I'm happy to say. So, way we see Vyzer is this type of virtual family office, in a sense, where you just So I'll get a distribution statement or an Excel spreadsheet that I have, and I'll throw it into Vyzer, and Vyzer will translate everything into data, create the assets, create the syndication deals, or update existing ones. So like I'll get an email from an operator saying this and this is your quarterly statement or annual statement or whatever, or K1. I'll just throw it into Vyzer, and it'll translate that into data and set up my assets for me. And then I'll link in my bank accounts into Vyzer. And Vyzer will automatically track distributions and capital calls for other stuff and match them to specific investments. Let's say I'm supposed to get $2,000 every quarter for this investment. Vyzer will automatically identify that and link it to the syndication and update all the performance and everything, or let you know, hey, that distribution you were supposed to receive never arrived, or it arrived and was under what you expected or over, whatever. And the third aspect is what we've struggled with is the ability to sort of understand what my cash position is today and how my cash position will look moving forward based on all my expectations. That distribution, those 10 different syndications that are supposed to distribute cash. This is my W2 income. This is my cost of living, my loan payments, and then add on scenarios on top of that. So I can I want to go on a trip next year with my family, or I want to buy a car or a boat. Just like see how everything will affect, or I want to invest now in Valkere, right? And see how, like, can I fund that $100,000 into Valkere? How will that affect my cash flow moving forward? Because we're all in wealth creation mode, right? We want to create more wealth, but we don't want to be cash poor. But in order to create wealth, you want to cash be deployed, especially in these high inflation times. You don't want to sit on too much cash, right? And so, and then the fourth part, which I think is the most interesting, is creating more transparency within this private investment world, like showing you what people like you are investing in, how many people have invested in each fund, how much money has been invested in each fund, communicate between people within the platform anonymously about their investments. So just like create that end-to-end aspect for private investments, for people that have those more complex portfolios that are interested in creating more wealth. And keeping it passive, right? The idea is that you don't have to do anything if you don't want to do anything. You just let us do the heavy lifting, or you can do everything on your own if you want. But it's like an end-to-end solution for that. And also has crypto and brokerage accounts and everything. Any type of investment in our asset class is also in it. So that's also important. So that's like a quick overview, I guess.
Yeah, it's pretty cool. I remember the webinar, or you showing us in our little mastermind group about it too. I thought it was awesome. The one thing that I keyed in on, of course, was the rating. You get to, they'll be able to rate and rank, general partners, so from most popular to best returns, right? Something like that.
Yeah. It's tricky, right? We want to keep it as objective as possible. Mm-hmm. Performance, for example, is a hard aspect to show because it's very hard to compare apples to apples, different risks, different geographies, different asset classes, different underlying assets. It's so difficult. So at the moment, what we're doing is just showing you how much money has been invested into each fund and how many people have invested into each fund.
That's cool.
And how many people have invested more than once. Because that's also important. I think it's even more important than anything else. That shows that people were happy and they did it again. And
it's all from the end user's perspective. It's not from the general partner's perspective.
It's all based on actual investments, actual cash transactions, actual documentation, like everything. Yeah, so it'll be very hard to abuse it. What we're also thinking about, like how to prevent that as well, but sort of, yeah, it's turning out to be a really cool platform.
Oh shoot.
I think I lost you guys. Sorry. I'm really sorry about this. I don't understand the internet connection. I apologize for that, guys. So what we do is like privacy and security wise is super important for us. Like we pay hackers to try and hack us just to make sure that everything is super secure. Because our information is in there as well. Like I want to make sure everything's locked and sealed. Yeah, so that's Vyzer. I mean, happy if anyone's interested, happy to sort of hop on a call, walk through it. We can have whatever. Like if you put my information, again, you guys can reach out to me for sure. And pretty responsive.
Awesome, man. And also, you're gonna be at the Best Ever conference. So if anybody's out there, you'll have a booth there, right?
Yeah.
Yeah. Cool. This has been awesome, Litan. Thank you, man.
Yeah, I appreciate it, Litan.
Thank you guys for having me. This has been fun. And again, I really apologize for this internet connection. It sucks when things break up and you don't hear everything, but it is what it is. So apologize for that. And thank you guys so much for having me. This was fun.
Yeah, man.
Yep, our pleasure. Well, hey, I'm gonna go ahead and no, I'm not gonna stop the recording, but hey, Litan, thank you very much. And thank you for everybody who showed up tonight. Any last questions before we log off?
Yeah, I had a question.
Go ahead, Steven.
Hey, thanks. So for Litan, my question is like, so what's your long-term vision for this platform? You know, where do you see it in, let's say, 5-10 years from now?
So the way we see it is to be like the ultimate wealth manager with the zero conflict of interest. That everything else. And sort of we want to also help also with taxes and the ability to maybe we're thinking about having a whole secondary market within the platform so people can liquidate their illiquid positions, maybe creating like SPVs within the platform so people can invest together into other funds that create their own feeder funds. But there's a bunch of things. We just want to create as much value as possible for people like us without any conflict of interest, which is really important for us. That's the way we see it moving forward.
Cool. Thanks.
Sure.
Yep. Thank you, Stephen. Anyone else? All right. Hey, that wraps up our monthly edition of Real Estate Investing Made Simple. We're super grateful for all you guys who came out. This being December, have a wonderful, happy, safe Christmas, Hanukkah, New Year. I think Kwanzaa's in there too. So whatever you're celebrating this month, enjoy it, make your memories, and surround yourself with peace and happiness. Have a great night.